Is Humpty Dumpty about to fall off the wall? Stay tuned. Welcome to this week's edition of Note School TV. And yes, it is the time of the month for the Note School TV monthly market update. So guys, we are psyched about bringing that to you today. But before we do, three things. Number one, like what you see. We love to see your comments. We love to see your questions, and we will certainly correspond back with you on those. So keep those coming in. Number two, subscribe to the Note School TV channel if you have not already done so. And number three, make sure and hit that bell notification. Boom, hit it right now if you have not already done so. Hit that bell notification so that you will be notified every week when we go live at 11:05 Central Time. Also, guys, to learn more about Note School and what we do at Note School, just simply go to noteschool.com/TV. And again, we will get back with you via email. We'll have a phone conversation. We want you to find out what all that we do at Note School. So with that, I am going to bring on our esteemed leader, our Chief Innovation Officer, our founder of Note School, Mr. Eddie Speed. Good morning, sir.
Hello, Joe. How are you?
Well, just wondering about Humpty Dumpty and that wall, right?
I'm telling you, that was a pretty good lead in right there. So
Right.
I think all of us are wondering about that. And a lot of things have happened along the way. And Joe, some people are really feeling a market trend. Some people not so much. Some people really are. More what I'm hearing of the biggest real estate investors across the country, because I'm in some masterminds with them.
Right.
More West Coast is really being affected. And obviously trends in the past have typically moved West Coast to East Coast.
Exactly.
So we are going to talk about that. Joe, I want to make sure that everybody knows there's two things I want you to leave here with, right? Nobody knows exactly what's going to happen. Our job is to present to you what is happening so that you can start formulating with facts what's happening, what's affecting the market. And number two, if we pose a problem, we always want to pose a solution.
Absolutely.
We are definitely seeing an impact in the market. Let me just say, Joe, that I'm a member of the largest, most advanced real estate investor group for single family houses in the United States, a mastermind that I've been in for a long time, right?
Yes.
Probably easily 80% of the top 250 house buyers are in this group, right? And I can tell you that the tone of that group was very different last time and last week. It was very different than in the past.
Yes.
Right? Very different. What I found was, though, I had a number of stage speakers specifically refer to Eddie Speed and Note School as some solutions that they need some help with.
Right.
So understand that we're going to find the opportunity in this, and we're going to end the session today with a very specific opportunity of some very interesting strategies that we have figured out with some tax loopholes. That like this could be a game changer for a lot of people in the market, like a game changer. So understand, we're going to present the information. Some of it's going to be a little bloody, but with every crisis comes an opportunity.
Well, Eddie, it's like you said earlier, back when we had our hair was much darker and we were probably a little thinner, right? We've lived through this, right? We've seen it. I love your saying, I don't have a crystal ball, but I have a rear view mirror. And this is one of those cases where seller financing is now right in the windshield, right? It's not in the rear view mirror anymore.
No doubt about it. It's just huge. All right, so let's bring up the slides and let's talk about where we're at. Joe, I think we're going to address several things today. We're going to talk about interest rates, the direction that they're going. We're going to talk about how that affects affordability. We're going to talk about inventory because there still is a lack of inventory. We're going to talk about the number of sales in the market. We're going to talk about what a recession could do relative to unemployment and affordability of, a business to make money. And we still are going to address the foreclosure issue, the default mortgage factor. How many are there, and can that affect the inventory? And then at the end, as I said, Joe, we're going to talk about a tax loophole that I think is crazy that nobody has figured it out before now. But I laughed and told somebody the other day, it only took me 12 years to figure this out, but I'm still the first guy to come up with it.
Overnight success, right?
I'm just saying, it's the truth, right? It's crazy. Joe, let's talk about what it takes to buy a house in what market.
Well, Eddie, you were talking about on the West Coast, then it moves east, and look at San Jose, California, there at 254.8.
Yeah.
And then it sorts the salary, but look a little bit below that where it talks about Sacramento being at 81,000. Man, that's 100 miles south, and boom, that's a big difference. And it's funny, Eddie, Sacramento was one of the most affordable cities last summer. They reported that 3 months later, it became one of the least affordable because everybody from San Francisco moved to Sacramento. But yeah, there are pockets in the country. Great stuff, but it's that West Coast, East Coast thing with Boston. But of course, as always, the West Coast wins the drawing.
Well, I can tell you this. I was in a mastermind last week with the biggest house buyers in this market.
Right.
In Boise, Idaho. Boise's not on there.
Well, there was a guy from Birmingham there, I'm sure, as well.
No, but San Diego, like the biggest house buyers in those three markets, plus several other West Coast markets, right? And I talked to them personally. And I mean, these are guys that do hundreds of deals a year.
Right.
And I'm telling you, all of them saying we are experiencing a significant market feeling because of rates. So once again, just pretty cool chart there. Joe, you did a good job of scraping that. We're back to the old mortgage credibility thing, availability. And that the reason that matters, guys, is because this was where they were at the top of the market. And that sort of draws correlation, Joe. That index says that it's just under 185.
Correct.
Okay. Now that index now is dancing right in here. And by the way, this is a little bit dated. And I have a drill down chart on the next one to show what's happened in the last 2 or 3 months. But that number right now, Joe, is right about 120.
Yeah.
Right. In fact, here's the updated chart that only shows just a few months. And Joe, look, we got up a little bit, and now all of a sudden we're back down right at that 120, like I said, right here. Just call it, Joe, 185 is your index had to be 185. That means the number of people that can qualify for conventional mortgage underwriting.
Right.
Okay. It was at 185 before the virus. It's dropped to close to about 125-ish, 120. Today we're at 120.
Yes.
Joe, that's about a third. That's about a third cut. And that means a third of the people that could get a mortgage before the virus, credit availability wise, not because of mortgage rates, credit availability wise is about a third less. And so the other thing, Joe, is we've said this before, but there's going to be nothing truer than this in the next few months. When everything is great in the mortgage business, Joe, people don't need creative financing.
That's right.
Right. When we have problems in the market, I got into the business in 1980 because seller financing was the hero, right? And I've seen so many cycles where seller financing filled a huge gap in the market. Joe, I'm going to say to you, in the last 90 days, we've gone from a real estate centric market to a paper creative finance centric market.
100%.
Right. We've crossed that bridge. And I think that's going to prove to be true. By the way, these shows are taped and you can go back and watch. And so if I was crazy, you can watch it in November and see if I knew what I was talking about here in June. Right.
Right. And Eddie, those penalty box buyers that you just, saw the hockey player there. By the way, that's that 30% that we were just talking about.
Yeah, this guy became, we call him a penalty box buyer using a hockey term, right?
Right.
He's that 30 to 35% that can't get a conventional mortgage. And now all of a sudden, Joe, with affordability, think that number's going up or going down?
More and more and more, unfortunately.
Yeah. Okay, Joe, this is a good slide here. Good job on this. This shows people the trend in what has happened to real estate value. So here's 2020, and here's where we were. Okay. And here's 21, and here's where we were. And Joe, it appears that this increase in value, median property value, which Joe was just under 300,000 back then.
Right. That was 2020. Yep.
And that makes the combination a little difficult to figure, Joe, because the deal is that we saw a almost 15% year over year increase. And the truth of the matter is, Joe, this makes affordability a big question. This is not the market of 2008,
no.
Right?
And Eddie, if you'll, that next line there where it says homes sold fell 7%. Well, remember, 1st of March, rates started that creep, right?
Yeah. So now that's where we said, when I go to this mastermind, that everything was rolling, everything was great. Hedge funds are buying all these properties, blah, blah, blah. It's all great. And all of a sudden now we've hit a number of affordability. And we're talking about, how does somebody go pay for this $430,000 house, right?
Right.
With the new market, right? And Joe, this chart right here, I think pretty much paints a picture. Yeah, this shows the median price house and what their payment is and what their payment used to be. And look at their payment, Joe, in 2000 and let's see, what was that?
2 years ago this month. That's what, June of 2020?
Their payment was this, and now their payment today is this.
Oh, and by the way, that's principal and interest. That doesn't include taxes and insurance.
Joe, quick math tells me that your mortgage payment has more than doubled in 2 years.
Exactly.
For the same mortgage. Now, by the way, this is a 30-year prevailing rate, 30-year mortgage. Now, we're going to talk about how many people are really getting that mortgage in a minute versus how many are not. But this was your mortgage payment 2 years ago, right? Right here.
Yep.
And now your mortgage payment today is right in here, about $2,000. Right. You're saying, Joe, that's just a crazy number, but it is what it is, right?
Right.
Affordability is definitely what everybody is worried about. There is everybody in the session here is doing this. Joe, I don't think a lot of people know this. And so this was a good catch for our team to pick this up, I think. Yeah. So, Joe, before the virus, the lion in the market was conforming loans, Fannie Mae, Freddie Mac, and they were about they were about 70% of the market share, right. In the low 70s.
That's right.
Okay. Right now, Joe, if you look, they are not breaking 60%.
That's right.
So this is conforming. That is Fannie Freddie.
Those are your QM loans, qualified mortgages.
Right. And this is non-QM. It is in the orange. Right. Okay. So non-QM, I'm trying to get the right color here so you can see it. Sorry about that. Non-conforming.
Right.
And this is FHA.
And the blue is the VA, right?
VA loans. So FHA's gaining market share, but the biggest market share is non-conforming. Now, by the way, Joe, they're not getting the best rate. So when we keep quoting these affordability numbers, we're assuming everybody's getting the best rate, the best loan, the conforming loan. But That's not what the market share says. Well,
and by the way, Eddie, best rate today on a 30-year fixed is somewhere between 5.77 and 5.9, right? So whatever the non-conforming is above that.
Of course it is. And the point is, conforming loans have lost almost 20% of market share.
That's it.
Now, understand this only goes, so understand this is a big deal, right? This is a big deal. Next thing is, so when we're quoting these affordability numbers, Joe, that we're assuming everybody got a conforming loan. Well, we all know by looking at this chart that that's not true.
No.
Joe, this is the rate hike, right? Whoops, I didn't mean to do that. Let me fix that. The rate hike goes now, as you said, just about 6%. Okay. Right. So if we look at the rate hike, I'm gonna get all my credentials working here on my pen. The rates are right about there, 5.8, 5.9. And they were, Joe, at this. Literally, they were at that. And so now all of a sudden, look at your debt to income ratio. So this is the blue jagged line here represents the debt to income ratio. And Joe, that number is crazy because we were right about 20% debt to income ratio, and now we are north of 35%.
That's right.
So
again, this has all happened in 2 years, guys. This is, I mean, that's like a rocket shooting up that blue line.
There's no doubt. And I mean, literally look at the correlation of the two lines.
Yeah.
Rates go up, debt to income ratio goes up. Now, this is all common sense, right? But it helps us understand this is why you have to have creative financing.
Yep.
Right? Now, Joe, there is a shortage of listings. Talk about this.
Well, if you look at 2017 to 19 being that baseline, 0 there at the top, right? So now you're looking from that point, and you're going from there to where we are today. And this was April, actually it's May. It didn't show the May there. But look at that, 67% down listings, okay? So, yeah, you know, we see that, you know, more houses are, well, it's just, that's what it is. This is the market. I mean, 67% is 2/3 of the market.
It's a weird real estate problem. There's plenty of real estate that can be done if you can get
that right.
if you can get the affordability right.
That's right.
All right. So, Joe, people have a lot of equity, tappable equity.
And by the way, that's not $12,000 up there at the top. That's $12 trillion up there at the top. And right now there's a little over 11.5 trillion in equity. And that is up to 80% LTV. That's not all the equity, but yeah, there's a ton of money there for between, you know, 0 and 80%.
Yeah, there's no doubt, Joe. It's there's a lot of equity, and that has two things. It means two things to me. First of all, people could afford to offer financing, right? Because they have a lot of equity. And they may be forced to offer financing, and I believe they will. And history proves that to be true.
Right.
All right, let's talk about the mortgage industry. The mortgage industry is in quite a turmoil, Joe. Yeah. Mortgage demand falls the lowest level in 22 years due to rising rates.
Well, the big banks are laying off their underwriters and their mortgage securities department. Rocket, Quicken, they're all cutting and slashing payroll because of this right here, 22 years.
We should be in the boom market for houses selling. This should be the ultimate boom market. Yes. At the time of the year, it should be the ultimate boom market. And we're seeing slowing home sales, and for the obvious reasons. Joe, last year, that was the loan origination market, right? $4.5 trillion was originated last year.
Big dollar.
This might hit this number this year. It might. And next year it's projected to be this. This shows you the amount of production of traditional residential mortgages.
Yeah.
So understand that if you're looking at it and going, oh, I wonder what's going to happen, the mortgage industry is in really a big turmoil, right?
It really is.
Another little issue in the mortgage industry is, Joe, there's a term here, and you're gonna want to explain that. It says 1.1 billion seller repurchases.
So, there's never an endless supply of money of liquidity in the marketplace. So these originated loans, are sold to the GSEs, the government-sponsored enterprises like Fannie, Freddie. And so when they're sold, they then go through quality control at the GSE, at Fannie or Freddie. And so over the last few months, well, the two most common reasons for repurchasing, right? So once it goes through quality control, they check the loan and they say, this doesn't really meet our guidelines. So they kick that loan back to the lender that originated the loan. So the lender then has to buy that loan back, and they own that in their portfolio. And the two biggest reasons, number one was value, right? Value of the properties, the debt to income the loan to value was out of whack. And then number two was debt to income ratio issues, right?
And you saw that spike in debt to income. These are called agency buybacks, right? And so this is a big deal. These loans are then sold in the secondary market, but they're sold as a loan with a dent in it, like the appliance, like a scratch and dent appliances. These are the industry term for this is scratch and dent loans. So by the way, these loans ended up in people like our hands, by the way.
That's right.
Right. So $1 billion worth of those. And Joe, well, let's talk about the Fed chair here.
Well, so the Chairman Powell, he says basically beginning of May, and I love what he said, right? Because I believe he meant it. He said, we at the Fed, we have the tools, we have the resources, and we have the will to get inflation under control, right? So here we are, and he, 75 basis points, and now the Fed will meet again at the end of July, 26th and 27th, and I'm pretty sure they're talking about another 75 basis point rise in rates at that point. We'll see.
And we're at a shock factor at the moment.
Yes.
Joe, I want to stop and I want to bring our sponsor in, Note School, because let me just tell you something. Our emails, our phones, our connectivity, our team is getting barraged with people that have known that creative financing and what Note School teaches, the opportunities are meaningful, but they have become extremely meaningful in the last 60 days. So let's hear from our sponsor, Note School.
Well, hello, everyone. It is Brian with the teaching team here at Note School, and I'm excited that I get to be the one to invite you to the upcoming Gold in Notes class. That's right. It is a one-day deeper dive class that we call Gold in Notes because of how valuable this time spent is. This is a full day that we really get to dig into the nitty-gritty, the whole world of creative financing, not just how to acquire more deals, how to get access to more capital, how to defer a lot of the taxes for us as well as for the sellers that we're talking to, and really learn how to create your own notes. And really, once you learn how to create your own notes, this is really where we spend an entire afternoon really pulling back the curtain on what the note business is, from wholesaling notes, buying and holding performing notes to really build your wealth. I'll even show you a strategy called partials, which is by far the best wealth building tool I've ever seen in the real estate space. And we're definitely going to spend some time talking about non-performing notes, which is by far the biggest opportunity in today's marketplace, solely because of the events that have happened over the past couple of years. This is when people are not paying their mortgages, and we're going to make a lot of big money from these bad debts, and we're going to help a lot of people get a second chance. It's an absolutely fantastic day. Come spend a day really dig in and discover a lot of this stuff so that you too can start building your wealth. It's a day meant to really be engaging. Bring your questions, bring your comments, bring your business problems, and we will see you there.
So, Joe,
there it is.
I thought we would go back down history lane a little bit, and let's look at inflation from back in the 70s, and let's look at this spike right here, Joe. See that spike right there?
Yeah, that's
That was around, that was in the early 70s. And then the famous one, obviously in 1980, look at that spike right there. That's when I entered the note business. Literally, that's where I entered the note business right there. Okay.
And when they mean 14% plus, it was plus.
Yeah, no kidding. These were interest rates or inflation rates.
Yes.
Now let's look at the spike that we're currently experiencing. And do you see any similarities?
Yeah.
So Joe, here's what we learned in the 70s and the 80s, and that was seller financing fills the gap that conventional lending doesn't. Okay? And seller financing filled that gap, and seller financing filled that gap. Wow. And I'll guarantee you seller financing was going to end up filling this gap right here. I believe that, honestly, I said this to a group of real estate investors, as I said last week. I said, if you don't know anything about creative financing, your ability to survive in this market is very, very thin.
And Eddie, I've got that smile on my face because you've been telling these guys that for a couple years now.
Well, they hadn't had to figure it out.
They hadn't had to figure it out. That's exactly right.
Right. But once again, we're in a different market right now. And this is just data. Yep. But I guarantee you, Joe, in these markets right here, in these markets right in here, seller financing was huge because believe me, and it was very common, and it's going to be very common again. Let's look at, Joe. Let's look at historical interest rates.
Yeah.
Right now, look here. This is a line that's basically 7.75% interest. Mm-hmm. Right here, right, the dotted line. Right, so this dotted line represents. But look at where we've been below it. But Joe, look how long we've been above it.
Yeah.
And I can tell you that seller financing was huge in those markets.
That's right.
And these people with all these equity, they can afford to seller finance.
They can.
It is going to happen. And so this is why I've said we've entered, because of rates, we've entered a note cycle market. Not a cash market, a note cycle market. Joe, let's talk about non-performing for just a minute.
Oh, yeah. The gorilla.
These are the number of loans that are more than 30 days delinquent. Mm-hmm. But by the way, they're not in so about 1.5 million loans that are more than 30 days delinquent, and they're not in forbearance.
Nope.
Right? So understand, this is inventory that's got to get foreclosed on or sold in some way, shape, or form.
That's right.
Right? We said the number of foreclosures are one of the variables that's going to affect where the market's going to go. Right? These are loans that are in forbearance, Joe. And if you look at this group right here, with the dotted blue, and this group right here, which is the solid blue, these are the remaining loans in forbearance. Okay?
Right.
Here's the catch.
A high of 8.1 million up there on the right. Yeah.
Okay. The term was extended, and they've done a lot of modifications on these loans, Joe, right? But the problem is they had about a 50%. So this is the total. Mm-hmm. This is the total of loans still in forbearance. The problem, Joe, is that's about 650,000 loans.
Correct.
The problem is the loans that they've written agreements on, about half of them have paid the modification agreement, and about half of them hadn't paid.
That's right.
Right. So the forbearance deal, I have called the assets that are remaining in forbearance are sludge, and they're going to be they're going to have a lot of defaults in it.
That's the bilge. That's right.
And that's been commonly discussed in the mortgage industry. Joe, I want to leave our audience today with a solution. We have identified some problems. We've said Humpty Dumpty might fall off the wall.
He may.
The question is, it's kind of like what positions you to be different than the market. If there's a market void, Joe, can you fill that market? Can you fill the void in the market? Right? And the answer is this strategy, although it is neither one of these laws are new. Marrying these two tax strategies together is crazy. Now, gigantic disclaimer. I am not an accountant. I'm not a CPA. I'm not an attorney. Okay. This is just a layman's opinion based on information I've gathered from licensed professionals. So I'm not giving you tax advice. I'm not giving you legal advice. Gigantic disclaimer here. But I will say this. This is well worth investigating.
Yes.
How about that, Joe?
100%.
So it's basically a little tax loophole for small landlords. Small landlords represent a giant piece of the rental property market. They own about 10 million houses that they don't have a mortgage on.
That's right.
That equity, that gigantic equity number you showed, that's part of these landlords. They don't have a debt. And the property values have gone way up in value. So the reason they don't want to sell is not because they love their tenant and managing it, because this is definitely an issue. They have a spreadsheet and a checking account, and they figured out they don't match each other.
Yep.
The spreadsheet says what it's supposed to do, and the checking account says what it's actually doing.
Right.
So you got this frustrated landlord, and the reason they don't want to sell is pretty simple. They got a tax problem.
Right.
Okay. So here's the idea. Here's the strategy. In everything we've just described, you can see why the landlord is worried about paying taxes, because the real estate market has been really good to him.
Right.
Maybe
Right.
managing the tenant has not been good to him. Okay. Yeah. We have found statistically more than 50% of the time, the small landlord is not doing well managing the tenants. Okay. But so their spreadsheet and their checking account aren't talking to each other.
Not communicating.
Joe, there's an IRS tax code called 453, and it describes a scenario where they can elect to do what's called an installment sale, right?
Seller financing, Eddie.
Basically, it's exactly right. You pay the gain over time. You only pay the money when you get the money.
Right.
So if you collected your principal, your capital gain over time, then you pay it when you collect it, not pay it when you all at one time up front, right? Yeah. Installment sale. And that's a big deal because it lets you stretch out how much money you're getting.
That's right. Because
now there's another IRS code, and this is related to capital gains.
Right.
And Joe, you have to have this amount as a single filer,
right?
Or this amount if you're a joint filer in capital gains in any given year in order to get a tax. So there's zero tax on it up until this amount. That's
exactly right, Eddie. Zero tax on long-term capital gains. If you are single filer, you make less than $40,400. If you're married, you make, which most hobbyist landlords are married, filing jointly.
So, Joe, is it possible with taking two tax strategies and marrying them together? Is it possible you could have a big gain on your residential rentals as a small-time landlord and sell it, offering seller financing and keeping your income below $40,000 on any given year, that you would effectively not have to pay capital gains tax?
That's right.
Is that what you're saying?
That is what I'm saying. Go check out IRS code 409. 40,400 is a single filer, 80,800. So yeah, below 80,800 if you're married, guys, that's a 0%. I like zero. In this case, I love zero.
All right, so let's look at this, Joe. This is a hypothetical. This is a very modest, typical case study. Very modest. They bought it. It's gone up 100,000 in value. It probably went up 100,000 in value in the past 2.5 years, but whatever, right? Just in this scenario, if they sold it today, they'd have to pay capital gains on $100,000. But if they stretch it out over time, because they're collecting such a small amount every year, they're not triggering the capital gains tax. They pay 0 up to the 40,000 or 0 up to the 80,000 if they joint file. So what we wanted to do today is to leave you with, while there is turmoil in the market, the truth of the matter is this is producing opportunities. This is producing an ability for somebody to come in with not just a buy low, sell high scenario and have a different way of positioning the market. And that's exactly, Joe, what I'm seeing right now with a lot of real estate investors. They know they got to change their game, and they like this game.
Absolutely.
Now, the seller is carrying financing, Joe, for you, right? You're the payer. You're buying a house from them, and and they're being the bank, because if they're the bank, they're avoiding getting taxed, right? The other thing about it, Joe, is this: once you own it, you could rent it, you can lease option it, you can wrap it with seller financing. Doesn't matter.
That's right.
You get to pick. And by the way, while Joe and I may like the wrap model, I know a lot of real estate investors that would rather just keep it as a rental, because now they fixed their debt service at below market rates.
That's right.
So they're saying, even if the market slides a little bit, I can rent my way out of it, because we know rents is going up.
Right.
What's wrong with that?
That right there is what we've been talking about for a little bit, right? And this is the piece of the market where you go, wow. And it gives that your seller, that we call them burnout landlords, right? It gives them what they wanted all along, and that's passive income, Ed. It's just passive income.
So a market condition, if you're looking at the top 500 house buyers in the business, I'm having lunch with one here in a minute, right? If you're looking at the top 500 house buyers in the business, then they solicit burnout landlords as their number one candidate or number one potential seller. Is the burnout landlord. So the category that we're talking about is the most solicited customer in the business, but most of them aren't selling because, once again, they're not because they love their rental. They're not selling because they're worried about a tax problem. And by the way, their tipping point right now is now all of a sudden they're really thinking, okay, our real estate value is going to go the other way, because let me just tell you something. There's all the evidence in the world that it may not. Joe, you're saying, well, why would you want to buy, Eddie, if the market is peaked out? Because I'm buying with artificially good financing.
There you go.
Right? The financing strategy is what makes it the deal, not the buy low, sell high price, the financing strategy. So there's all these things that, as we unfold these stories, when how Note School teaches this stuff, people go like, oh my goodness. Joe, what do they say? Never waste a crisis.
Never waste a good crisis, right?
All right, Joe, close us up, my friend.
Very good. So, guys, I would have to say that this is probably one of the best episodes that we've done in a bit, right? And you are going to want to watch this over and over and over and over again. And listen, share this with your friends, right? Hit that share button as well. Share it with your friends, because again, this is where the industry is going. Again, noteschool.com/TV. If you have additional questions, want to know more about Note School, please get in touch with us. Please reach out to us. This is certainly the time to do so. And, guys, well, we'll see if Humpty Dumpty falls off that wall and has a great fall, or we'll just see if Humpty sits right there and, sits there for another month. So thanks again for being here with us, and we'll see you guys next week on the next episode of Note School TV. Have a great 4th of July weekend. Be safe, have fun, and we'll see you guys on the other side.